And ladies, thank you so much for the time today. With me is obviously Jeremy Wyeth from Treasury Metals, and we have not had him on our YouTube channel before. And I met the CFO of the company, Oren, back in the spring, tracking and owning the stock on and off since 2020. I think it's just a very misunderstood story in terms of a value manager's perspective, which we are. And with gold here now at 115 consecutive days over $1,900 an ounce, there is a massive disconnect, in our opinion, between the price of gold and gold juniors like Treasury Metals. So, Jeremy, welcome to the show today.
Thank you very much, John. It's a pleasure to be here to chat to you and to your listeners.
Thank you so much. So, why don't you just take us through a few slides here, and then I'll ask a few questions and then open it up to the group.
Sounds perfect. I'd like to talk about the Goliath Gold Complex. Just push you towards our cautionary statements. It's the two properties, Goliath and Goldland, were brought together in 2020. Situated in northwestern Ontario, between Dryden and Sioux Lookout. It already has a federal EA on the Goliath property, and I've been around almost 40 years and I have never seen infrastructure like we have around this project, and I'll come back to it a bit later and describe that. I've spent the last 2.5 years with Treasury and brought together a team of experienced development and construction focused senior management so that we can actually take this project forward. And it's not something you see a lot in the industry where at an FS stage, we already have a team with the experience that we do. We put out a PFS earlier this year, which demonstrated some really solid economics. And your intro on the gold price, we did it at $1,750 gold. We saw NPVs at $336 million. 25.4% IRR. And just using today's gold prices, that NPV goes up to $500 million and the IRRs into the mid-30s. We updated the mineral resource this year as well, 2.1 million ounces measured and indicated, and 0.8 million ounces inferred. So just under 3 million ounces measured, indicated, and inferred. And I'll also go to it a bit later. Of the 65 kilometers of strike that we have, 330 square kilometers, we've effectively drilled about 5. So we are really a huge opportunity for upside in that. And we're in a strong financial position, which is good for us, especially with the markets the way they are at the moment. We had just on 12 million of cash at the end of March. If we look at the capital market side, First Mining own about 13% of us, management and board 2%, 36% institutional, and then the largest chunk, 50%, is high net worth and retail. And that's split 50-50 between the US and Europe. 4 analysts covering us at the moment. This was put together earlier this week, share price 27 cents. About 148 million shares outstanding and a market cap of about 40 million. A lot of the warrants that you see there, 12 million of those 20 million warrants expire in August. Fully diluted, about 180 million shares. And as I mentioned, the cash position of just over 12 million. The last project I built was the Victor Diamond Mine in Northern Ontario, and it was at the end of a 400-kilometer winter road. So when I was approached to join Treasury, I took a good hard look at this. This de-risks a project significantly. The fact that we're on the Trans-Canada, we have CP rail, natural gas, and we actually have the hydro line running across our property very close to where our process facilities will be. So you can see the property on the right-hand side, Dryden at the bottom, Sioux Lookout at the top, 65 kilometers of it. All the infrastructure will be built at Goliath, and then we will be tracking material from Goldland and Miller. With the downturn in the paper industry, we've actually got ready access to a lot of experienced people in Dryden and Sioux Lookout, a lot of them at the moment working out of town because of the downturn in the paper industry, but really looking forward to being able to work back from home. Goliath already has the environmental assessment done, and Goldland was actually a past producer. So we have the opportunity there to benefit from the fact that it's a brownfields project rather than a greenfields. I mentioned the team. I will send this around, so I won't spend too much time other than to say, between these 6 people, we have just short of 150 years of mining experience, and that is everything from exploration, construction, studies, operations. And for some people like Rachel, this will probably be her 6th mine that she's taken from 3 or 4 people right up to a full operations complement. Again, something you don't typically find at this stage for a company of our size. Some highlights on the PFS. I've mentioned the 336 million NPV, 25.4%, and then that goes to $500 million and 33% at today's gold prices. CapEx of 335, so it's not a $1 billion project that people are going to battle to finance. It's manageable. 2.8 year payback at 1750 gold at today's prices, about 2 years. 1.2 million ounces recovered. It's a 13-year mine life, and I'll show you a slide a bit later that breaks it down a little bit, averaging just under 110,000 ounces per year for the first 9 years before we get into some of the stockpiles. Cash costs, 892 US, and all-in sustaining just over 1,000 US. That's for years 1 to 9. And the part I like, my background is operations and construction. It's a simple project. It's technically simple. It's a gravity CIL gold plant with a huge amount of exploration upside potential. Again, this slide will be sent out so people will have access to it, but the numbers I want to just draw your attention to: gold head grades in the first 5 years, sitting around 1.7 grams per ton. For the first 9 years, about 1.6. But with all of that, if we look at the post-tax free cash flow, the first 5 years, it's over 100 million a year, and that includes bringing in an underground mine concurrent with the open pits. And then if you look at the first 9 years, it's about 90 million. So, that generates in the first 5 years, $727 million of EBITDA, and just over $500 million worth of post-tax free cash flow. And if we look life of mine, that EBITDA number goes to 1.3 billion, and the post-tax free cash flow to 870 million. So it is a mine that puts out a lot of cash when it's up and running. And part of that exploration upside that we have is we've got 9 really good years, and then in years 10 to 13, it's still making money. But we have that opportunity with the fact that a large portion of our property is underexplored, is to bring in additional material at higher grades to just extend or to delay when we bring the lower grade stockpiles into the mole. For the next 12 to 24 months, we finished the PFS early this year. We're doing some optimization work, which came out of some of the reviews, and then we've already started the feasibility in some areas. With the PFS done, we're advancing our provincial permitting and negotiating agreements with the local communities. We raised some flow-through funding a month or 2 ago to allow us to get into some of the areas. There's some areas close to where the mole will be. Fold Nose, Far East, Interlakes, that we've done some drilling in, got some really good results, and we're doing some follow-up work there. I do need to say that the resource won't change much between the PFS and the FS. We've done all the infill drilling and conversion. This is more exploration upside for at the end of that 9-year period to bring in new material, both open pit and underground. We see the first mover advantage here. There are no existing moles in a 200 kilometer radius. So if we can get up and running with huge potential on our property, but also the hub and spoke model has been very successful in other operations, and we see the opportunity here for fault treatment and such like on our property too. If we look at relative valuations, we monitor ourselves against 10 or 12 gold development companies, North American based. You can see at 2.1 million ounces, we're towards the right-hand side of that graph. On market cap, we're at the very far end of it, so not really getting the recognition of our position. And then if we look at P to NAV, it's interesting, the average of our peer group is trading at about 0.27 to NAV. We're trading at 0.11. And of interest, that average 18 months ago was 0.5. So the industry has seen those numbers come down significantly. The opportunity here for a re-rate has to be there. If we can just get ourselves closer to the average, both on that one and on the enterprise value per ounce, I mean, we're sitting at $14 per ounce with the average at, in the 60s. So again, if we can move ourselves, and we see the opportunity for this re-rate, and I think you mentioned it, John, just the disconnect between the market, the gold price, and recognition. And I think there's, we've been around for a while, and I think, some people have been involved for a while and are waiting for something to happen. And in fairness, until the two properties were put together, I don't think it was big enough to build a mine on it. So now that that was done in 2020, we now have the opportunity to move this forward. And I think just to end off, 5 points I'd like you to take away. Project with a federal EA, sought after tier 1 jurisdiction, Northwestern Ontario. Some of the best infrastructure I've ever seen in the world. Good solid PFS numbers, very well geared to the improving gold prices. That opportunity in the 330 square kilometers for extra growth within our own properties. That management team that's in place that can finish the studies, get it into construction and into operations. And then financed, we well funded through 23, takes us through to the end of the FS and towards project financing. So an opportunity with a re-rating, people to get in and see the benefit of the market turning. And our plan is to be ready when the market turns to be able to move the project forward by doing all the de-risking that we can during the next 12 to 18 months. And that's the end of that, John.
Great, thank you, Jeremy. Can you go back to slide 12?
Oh, sorry, am I still sharing?
You're still sharing.
Slide 12. Yes, there we go.
Yeah, so just for people that don't know this, because I mean, there's so many acronyms in our business. P to NAV, guys, means price divided by NAV, net asset value. So when you look at the industry average now, as Jeremy pointed out, it's really drifted down. But in a normal, to up gold market, you're going to see an average closer to 0.5, right? And so at 0.11, that's the re-rating that Jeremy is referring to, correct?
Yes, correct.
And then if you were to go back, I think it was slide 6 or 8 when you were talking about the NPV. Number 8, I guess. There you go. So this is something that is consistent with a lot of junior gold miners, guys, in the sense that conservative companies like Treasury will use a lower gold price, right? And so when you're using 1750 as the base case, we're clearly not at 1750 right now, right? We held 1800 very nicely in January, and things have really turned up since then. As I pointed out, for those of you that joined late, we've had gold over 1900 an ounce for 115 straight days right now. So at 1950 an ounce, let's just say round numbers, this NPV is around $500 million, and the IRR goes to about 33 to 35%. Is that about right?
That's correct. Those are the correct numbers, yes.
And then also a metric on this same slide that a lot of you like to look at is AISC in the bottom center there. That stands for all-in sustaining cost per ounce. And as you can see, at $1,000, let's call it, very, very reasonable considering gold is at 1900 plus. So one of the things that I see with a lot of projects is an AISC of maybe 12 or 13 or 1400. Obviously, in the last few years, the average AISC has creeped up into the 1250 range. So this is below average in terms of cost per ounce out of the ground, which I think is, one of the things that attracted me. Another one of the things that Jeremy pointed out that I liked was the infrastructure. Jeremy, can you talk to that a little bit?
John, if you look at most projects, they tend to be in places that are really difficult to get to. You've got no power. The last one I built, I had to build a power line for 600 kilometers, a winter road for 400 kilometers, put in airstrips. And I actually smile here because, the region we're in has seen 60 million ounces of gold mined, and there are another 40 million ounces in 43-101 resources. And anyone in that region that orders any bit of mining kit drives it past our site. The Trans-Canada runs past our site. It's that close. So, where a project is typically made more complex is when you battle to get stuff. The previous project, I had to move stuff in 9 months ahead of schedule, take it to Moosonee, take it up a winter road. Here, you're not constrained by that. You can bring it up. You've got rail right to Dryden, right past our site. You've got road all the way there, and then you've got hydro that comes right across our site. We're actually in discussions now as to they'd like to move it, and it's actually getting even closer to our mill facility. So you don't often see that in the mining industry. Most people are battling to get that infrastructure or get delivery of their goods. For us, it's not a big issue. We're even looking at warehousing stuff in Dryden because it's so close. It's 15 minutes. We don't have to build warehouses on site. It's that sort of opportunity that in 40 years, I haven't seen that before. So that's what attracted me to this project.
That's excellent. Thanks for the color on that. Going through the presentation notes here, it seems that you mentioned that your background is in, did you say construction?
I spent some 25 years within the De Beers Anglo Group, and I worked on 4 continents and ended up, basically, I've built mines, I've commissioned mines, I've decommissioned mines, I've run mines. So I've worked underground and open pit. So I've really been fortunate to have that opportunity in a company large enough that it had those sorts of opportunities that they could offer. So, I think that's useful when you're coming into something like this. Very different scale.
Yeah. Okay, so we have one question in here. When will construction decision be made? And I know that you probably can't publicly tell us that, but I just wanted to ask it.
John, we've got a lot of work to do. We're finishing off the feasibility, which typically takes 9 to 12 months, and we're busy with the permitting and the agreements. So,
okay.
That is the work that needs to be done before we can get into a construction decision. I think it's a little early to start putting exact dates to that.
Yeah, I agree. Well, thanks for the question, though. One other question here comes up. Hold on one second here. Trying to get to the chat box. Here we go. What's the current debt breakdown, annual costs, and current interest rate?
Oren's actually on the call. He's the best guy to do that. We've just extended the convert, and we've actually negotiated a better interest rate than we had previously, and it's now extended through to 2026. It's under 10%, and we have the opportunity there that we can pay it back in shares or in cash at our discretion.
Okay.
And it's $5.4 million US, and it's, as I said, it's a legacy debt that's been around for quite a while. It actually was renegotiated about a month ago.
Excellent. Okay, thank you. Another one, once the mine is fully functional, how many workers are going to be employed during this phase in year 1?
Typically on a mine of this size, you're probably looking at 200 to 300 people. It's a small mine, it's 6,500 tons per day. There will be more people during construction. And then depending on exactly what shift configurations will determine how those numbers are finalized.
Okay. There's some duplicative questions here. So are there, outside of the slides you gave us today, Jeremy, is there something more advanced in the presentation deck on the site or somewhere on the site that can show the blueprint for, you know, how construction would look or how year one would look, please?
There's on CEDAR is the whole pre-feasibility study that has recently been published. It's also on our website.
Okay.
So that has got pretty much all the detail that's available. We'll show layouts, we'll show everything on how the site will look.
Okay. That's every question we have. And if there's nothing else, I just wanted to thank you, Jeremy, because I know it's a difficult time with, summertime with families and all. And also to all our participants today, I really appreciate you guys making the time. And as I mentioned, Brian had another question here. Where is it located? So can you give us like the part of Canada that this is in and any comments around that, Jeremy, before we leave?
It's northwestern Ontario. So from Toronto, we typically fly into either Thunder Bay or Winnipeg, and then it's about a 4-hour drive from there. So it's very close to the town of Dryden. So it's between Dryden and Sioux Lookout, and the other small town closer by is Wabigoon. So it's in the Red Lake, Rainy River, that sort of mining belt that's there.
Yeah, it's a really good area. I know that Rainy River area quite well from New Gold, and it's nice that you're in a nice jurisdiction. As you pointed out, with the risks that exist in jurisdiction today. I was just asked a question on another interview yesterday about the top 3 risks to mining, and I listed jurisdiction as number 2, I think now, where I wouldn't have done that a couple of years ago.
Absolutely. And, I've worked on 4 different continents, and I must say it's an absolute pleasure being in a jurisdiction like this.
I'm sure. So thank you again, Jeremy. We have to wrap it up here, but looks like there's a couple of additional questions. Everyone, my email directly is john.feneck@yahoo.com. If you guys want to hit me there with any questions, I'll be sure to forward them to Jeremy and his team. Jeremy, would you like to give your email out as well?
Yep, Wyeth, JWYETH @treasurymetals.com.
Perfect. Thank you so much. Yeah, go ahead, Jeremy.
No, I was just going to say thanks, John. I appreciate you taking the time as well, and to your listeners. And any questions, there's processes on our website where people can ask as well, or email us directly, and we'll do our best to get answers to them as quickly as possible.
That's great. We always love companies that are responsive, and you and Oren have been that since we met. So thank you, and have a great summer, everyone. Thanks for making the time.